that will flow on to lower interest rates for other borrowers. More specifically, quantitative easing refers to the purchase of financial assets such as government bonds or other financial instruments by a central bank with a view to achieving the same goals as might otherwise be pursued. Lower interest rates for other borrowers. By cutting interest rates, Rathi, my voice is coming over myself there. Financial assets. I think that's better. So typically, quantitative easing involves the purchase of government bonds, but as I'll show you, central banks have at different times purchased mortgage-backed securities and other asset-backed securities. They've bought corporate bonds, they've bought commercial paper, and in some instances, they've bought exchange-traded funds with equities. That's mainly the Bank of Japan. Some central banks have also made loans as part of their QE programs. Most commonly, that's been loans to banks in the expectation that they would in turn on-lend those funds to their customers. But there have been instances where central banks, as part of their QE programs, have made loans to other organisations, such as securities market dealers, businesses, and in a couple of instances, even local governments and their affiliates within their respective economies. The word quantitative is used in this context of quantitative easing because central banks which typically adopt it specify in advance the quantity of the assets that they intend to purchase or the amount of loans that they intend to make. They might say, for example, that they intend to purchase a specific quantity of bonds over a period between now and some specified date in the future, such as the end of the current calendar or financial year. Or alternatively, they might specify that they will buy a given quantity of bonds or other assets per week or per month, such as the Federal Reserve, for example, has been doing in respect of its asset purchases, or as the Reserve Bank has been doing on a per weekly basis in respect of its bond purchases. That's as distinct from conventional monetary policy where the central bank specifies a price, typically, of course, the rate of interest, the official cash rate. And in order to fund the purchase of financial assets, whatever it is that they're buying, or the provision of loans to banks or others, the central bank creates what's usually called money when it purchases bonds in financial markets, for example, by way of reverse auctions or tenders. It will pay for those by crediting the account which the seller of those bonds has with the bank at the central bank. And that shows up in the financial system as an increase in the seller's bank's deposits at the central bank. In the same way, when a central bank makes loans to commercial banks within its borders, that it in effect credits the accounts that those banks have with the central bank, as all central banks do as part of the way that central banks interact with other participants in the financial system. So that's what quantitative easing is. Let me say a little bit, Rathi, if you will allow me to share my screen, which at the moment I'm not able to do. If you can let me do that, I will talk a little bit about what quantitative easing isn't. Quantitative easing is not, and this is important, quantitative easing is not about, there we go, there is, hopefully people can now see that screen. Quantitative easing is not about printing money in the way that, for example, Weimar Germany did in 1922 and 1923, or as Hungary did towards the end of World War II, or that any number of banana republics in Latin America did in the 1970s and 1980s, or more recently Zimbabwe and Venezuela have done. In those instances, central banks did literally print enormous quantities of banknotes to finance government spending, or in Weimar Germany's case in the early 20s, to finance the payment of reparations to Britain and France under the Versailles Treaty, of which Maynard Keynes was so critical in his book, The Economic Consequences of the Peace. And those money printing episodes in days gone by did result in what Milton Friedman famously described as too much money chasing too few goods, and usually in massive currency depreciations that set up a vicious circle of rising inflation, falling currencies, feeding through into higher prices for imported goods and services, and thus ultimately to what became in almost every one of those episodes hyperinflation. We're not talking about that here. Nor is quantitative easing about directly financing government deficits. No advanced economy central bank is today, or has done in the last 20 years, directly purchased government securities from governments in the so-called primary market. When central banks buy government bonds as part of their quantitative easing programs, they're buying them in the so-called secondary market from institutions, banks, pension funds, or whoever else it might be, who've acquired those bonds somewhere else. It may have been directly from governments in the primary market, or they may have bought it as secondhand bonds from someone else beforehand. Certainly, quantitative easing makes government deficits easier to finance by allowing governments to sell new debt at lower interest rates than would be possible otherwise. But that is not the reason why central banks who are doing quantitative easing are actually doing it. I'll talk about why central banks are pursuing quantitative easing in a moment. But I guess the point I want to make here is that quantitative easing is not a variant of so-called modern monetary theory. That's a big topic in itself, and I'll talk about that in the next of these webinars that will be held on the 24th of August. But let me say here, and I'll explain in more detail in a month's time, what the differences are between quantitative easing and modern monetary theory. Let me just say here for the moment that modern monetary theory does hold that central banks can and should finance government deficits directly, and that, so MMT argues, when central banks do that, that is not inflationary in the way that the monetary financing of deficits in the examples I gave before has traditionally been. The third thing quantitative easing is not really about is about central banks supplying emergency liquidity during periods of acute financial stress or financial crises, such as most of them did during the global financial crisis of 2007 through 9, or as most central banks also did in the early days of the pandemic in March of last year, when many financial markets seized up and it looked as though we might have been staring at the face of another rerun of the financial crisis of 12 years ago. Central banks have been supplying emergency liquidity during financial crises for more than 150 years. Famously, in his book Lombard Street, written after the Panic of 1872, Walter Bagehot, who was the founding editor of The Economist, said that in these circumstances, central banks should lend freely at penal rates of interest in order to stop the financial system from collapsing. And central banks have been doing that for a very long period of time. That is not new, even though central banks have done it, as I mentioned, on a number of occasions over the last 15 or so years. But we're not talking about that today either. What we're talking about is how central banks have chosen to respond to a profound change in their operating environment. And here I'm going to talk about a little bit of economic theory. I'm going to try and do that in a way that doesn't require an undergraduate degree in economics, let alone anything more advanced than that. But if I don't explain it very well, please feel free to pop up with a question and I'll do my best to explain it in more comprehensible terms. Economic theory, going back to the Swedish economist Knut Wicksell, who was a contemporary of Maynard Keynes, has held that there is a natural rate of interest, which expressed in real terms, that is, after taking account of inflation, is consistent with an economy that's operating at its sustainable full employment level. That's sometimes called potential GDP, when all the labor and all the capital that wants to be and can be gainfully employed is employed, and thereafter economic activity or GDP is growing at its potential rate, dictated by the rate of growth of the population and of labour productivity, then Wixell's theory that's been widely accepted ever since is that interest rates will gravitate to some natural level that's consistent with the economy continuing to grow at its potential rate without generating upward pressure on inflation. And in economics textbooks and learned articles, that so-called natural rate of interest is often referred to as R star. Now, as the charts that I'm showing here indicate, economists at central banks and in universities have come to realize that over the last 50 years or so, that natural rate of interest, the one that's consistent with an economy operating at full employment and growing at its potential rate, has been steadily trending down. That's obvious from the left-hand chart, which refers to the United States, but you can also see evidence for that in other advanced economies such as Canada, the UK, and the Euro area. And people have produced similar results for Japan and also more recently for Australia and New Zealand. But I'm not going to show all of those charts here. I just want to illustrate the way in which well-regarded economic research suggests that that natural rate of interest, consistent with an economy operating at full employment and growing at its potential rate without putting upward pressure on inflation, has been steadily trending down over time. But you'll also see from those charts that there was a particularly large drop around the time of the global financial crisis in 2008-9, a drop in the natural rate of interest in the United States in particular of more than a percentage point, and something similar to that in the Euro area, though perhaps not as much in the UK or Canada. Now, why has that happened? Well, again, research that's been widely accepted suggests that one of the main reasons for the decline in the natural rate of interest is that the rate of potential GDP growth, the rate at which an economy can grow once it's reached full employment without generating unwelcome inflationary pressure, has declined for at least three reasons. The first, that's probably obvious, is that the rate of growth of most advanced economies' population has slowed. And in particular, the rate of growth of the working age population has slowed because of the aging of the baby boom generation. An increasing proportion of most advanced economies' populations are over the statutory retirement age. And although in most countries, people don't have to retire at a given age as rigorously as used to be the case, nonetheless, that's what most people choose to do. There are some advanced economies like Japan and Korea and Italy, where the working age population is actually now declining. And in almost every advanced economy, the working age population is growing at a slower rate. The second thing is that in many economies, the proportion of the population that wants to work, the so-called labour force participation rate, is not rising at the rate that it had been from the 1960s, when women started to enter the workforce much more commonly than had been the case in the years immediately after the Second World War, or indeed before then. And more recently, as people have stayed in the workforce for longer periods than they might have done when a greater proportion of the workforce worked in physically demanding jobs in manufacturing or agriculture or mining, or when statutory retirement ages were more rigorously enforced. In the United States in particular, the participation rate actually peaked around 2000 and has been significantly lower than that ever since, in part because, as has been well documented by economists and others, of the spread of the opioid epidemic in important parts of the United States. And that's a bit of an outlier for the United States. In other countries, participation rates have continued to rise, as they have done in Australia, but there is probably some kind of natural ceiling based on choices that, for example, women usually, but not always, make to take time out of the workforce to care for children or for elderly relatives, and, as I say, people's natural inclinations to retire at an age that they think it's appropriate and when they can afford to do it. And the third factor that's contributed to a decline in the potential growth rate in most advanced economies has been the trend slowdown in the growth rate of labour productivity. Now, we could take an entire webinar to talk about some of the reasons for that, and maybe at some stage we should. But at the moment, let me leave those factors there and note that there are also a range of other factors that in the formal modelling that I've depicted in the chart on the left are often grouped under the heading Z that have contributed to the decline in R star, the natural rate of interest. And one of those that former Fed Chairman Ben Bernanke devoted a lot of attention to was what he described as the global savings glut. That is to say, the significant amount of savings available to the world economy because of the build-up of very large savings in emerging markets, particularly East Asia, in the aftermath of the Asian financial crisis, which prompted most Asian countries to seek to run big current account surpluses and accumulate them in the form of foreign exchange reserves, partly reflecting the natural tendency of most of those countries to save higher proportions of their household incomes than in Western economies. But that also extended to oil-producing nations that ran big surpluses when oil prices were relatively high. And it was also characteristic of some European countries, particularly Germany and the Netherlands. And that big increase in the supply of savings, combined with what appeared to be a downward trend in levels of business and public investment, which in turn resulted in a reduction in the demand for borrowings. So an increase in the supply of loanable funds and a decline in the demand for loanable funds is widely accepted as having been an additional factor putting downward pressure on the natural rate of interest R star. Another factor that's been figured by many as contributing to this decline in the natural rate of interest is the increased demand for risk-free assets like government bonds from pension funds, in part as a result of regulatory pressure that is in turn put downward pressure on the yield or the interest rate on those assets as more people are chasing them. And then finally, some people suggest that lower expectations of returns from riskier assets, simply because the prices of them have risen so much over the last 20 years that some people think they can't keep going up at the rates that they have been, may also have pushed their yields lower as well. Nobody can be absolutely sure about these things. There are no definitive, irrefutable proof, but they sort of make sense in terms of providing an explanation as to why the rate of interest that's consistent with steady, non-inflationary growth at full employment might have declined in so many countries around the world. Now, I've been talking here about R star, the natural rate of interest, in terms of the real rate. But of course, what actually gets set in financial markets and by central banks is the nominal rate, and people make their own adjustments to that based on their experience and expected inflation in order to derive some kind of real rate. So what this chart shows is, in the context of the United States, how potential growth in real GDP has slowed from about 4.5% per annum in the 1960s all the way to 1.5 to 1.75% per annum in the past decade, while inflation has dropped from an average of about 6.5% between the mid-1970s and the early 1980s, and a peak within that period of over 10%, to less than 2% per annum on average over the past decade. Now, what that means is that while, as I've already shown you, there's been a steady decline in R star expressed in real terms, in nominal terms, that is, once you add back inflation, the nominal sustainable interest rate has fallen from an average of over 10% during that high inflation period of the mid-70s through the early 80s to less than 2% over the past 10 years. Now, remember, I've said that the natural rate of interest rate, R star, is a theoretical or long-term concept. It's not something that you can observe at any particular point in time. And of course, the economy is hardly ever at the ideal state of affairs where labor and capital are fully employed and the economy is growing at its potential rate. Indeed, no central bank or policymaker knows for sure what the potential growth rate is. So you can't really be sure that you're growing at it, even if you think you know what it might be. And so almost always, the economy is operating at either less or more than full employment, or as economists and central bankers like to say, it either has a positive output gap or a negative output gap between actual and potential GDP. And whether the output gap is negative or positive, that is, whether the economy is operating at either over full employment or at an unacceptable level of unemployment, is one of the major determinants of whether inflation is higher than or lower than the central bank wants it to be. For that reason, it's almost never the case that the actual or observed interest rate in an economy is equal to R star, the rate that would be consistent with steady growth at the potential growth rate with the economy operating at full employment. And in fact, the central bank intentionally moves its policy interest rate around. In the US, that's called the federal funds rate. Here in Australia, we call it the cash rate, as everyone will know. They are continually moving it above or below what they think the natural rate of interest might be, according to whether they want to stimulate faster economic growth in order to ward off a potential recession or promote a recovery from a recession if it's already happened. In those cases, they'll set interest rates below the natural rate. Conversely, if they want to slow economic growth because inflation is either threatening to get out of control or actually is higher than they want it to be, they'll typically set interest rates at above the natural rate of interest R star. And central banks, although they would deny that they follow any mechanical policy rule in setting interest rates, nonetheless have been observed over a long period of time to behave as if they do. One of the most widely followed policy rules that central banks appear most of the time to abide by is known as the Taylor Rule, after John Taylor, who devised it on the basis of econometric studies in the early 1990s. And what the Taylor Rule essentially holds is that central banks set interest rates as the sum of the inflation rate plus the weighted average of the difference between what inflation actually is and the target for inflation, and what the level of economic activity is and the full employment level of economic activity, or what, as I've previously described, as the output gap. Now, that equation leaves open the possibility, for example, that at different times the central bank could put greater weight on its inflation objective than on its economic growth or unemployment objective. But on average, over a period of time, the Taylor Rule holds that they'll weight them equally. And you can see from the chart on the left that, at least in the United States, and other research suggests this holds in other countries, interest rates do typically follow, in both time and magnitude, the prescriptions of a Taylor Rule like this. But I want you to look closely at the chart with the pink line in the last 10 years, because what that tells you is that since the onset of the global financial crisis, there have been two occasions, both during the financial crisis and with the onset of the pandemic, when the Taylor Rule is telling central banks that they should be having negative interest rates. And that's something that central banks have found problematic, because having negative interest rates does present a number of both conceptual and practical difficulties for many central banks. It's true, and I acknowledge that there are some, the Bank of Japan, the European Central Bank, the Swiss National Bank, the Danish National Bank, and for a while, although they gave it up, the Swedish National Bank, have had modestly negative interest rates of between -1 and -0.5 percentage point. In the case of the European Central Bank and the Bank of Japan, for more than 10 years, in the case of some others more recently. What I note in that context is that all of those central banks who've had negative interest rates instituted them before the onset of the recession that was induced by COVID-19. And that none of those central banks who had negative interest rates before the pandemic have seen fit to make them more negative, which you would think they would have done if they truly believed that negative interest rates was a good idea. Indeed, the Swedish Central Bank, which did institute negative interest rates in 2015, but after a review of their effectiveness, backed away from that in January 2020, didn't go back to negative interest rates when the pandemic struck and threw Sweden, like every other economy in the world, into a serious recession after March of next year. And I suspect the reason the other central banks who've had negative interest rates haven't backed away from it is that they don't want to admit that they were wrong. The problem with negative interest rates, apart from the damage it potentially does to the profitability of the banking system, and I acknowledge that in this country in particular, most people wouldn't see damaging the profitability of the banking system as a major problem. But as Peter Costello, the Australian Treasurer, used to say, if there's one thing that's worse than profitable banks, it's unprofitable banks. And in Europe in particular, where bank profitability has never recovered from the beating it took during the global financial crisis, low levels of profitability have been a factor restraining bank lending. So more commonly and closer to home, neither the Federal Reserve nor the Reserve Bank of Australia have any appetite for negative interest rates at all. But that doesn't mean that central banks shouldn't do anything at all. That's why those central banks who have encountered the zero lower bound for interest rates have turned to quantitative easing, to the purchase of financial assets, as I described before, as a way of responding to persistently below target inflation and recession, rather than just simply sitting on the hands and saying, well, we've cut interest rates to zero or less and there's nothing more we can do. You can see that, for example, the Bank of Canada, that didn't do any quantitative easing during the global financial crisis of 12 years ago, has started to do it in a more significant way with the onset of the COVID recession. Likewise, in Australia and New Zealand, where interest rates didn't need to be cut nearly as low during the financial crisis as they did in the United States, Europe, Japan, and the UK. By the time the COVID recession came around, they did encounter the zero lower bound. Although New Zealand flirted with the idea of negative interest rates, they never went there, and the Reserve Bank of Australia ruled it out from the very beginning. Both of them, as you can see from the right-hand chart, have embraced the concept of quantitative easing with a fair degree of enthusiasm, increasing their balance sheets from less than 10% of GDP before the pandemic began to something in excess of 25% of GDP as of the past couple of weeks. Now let's look in a bit more detail about what those central banks who've been doing quantitative easing have actually been doing in practice. And to do that, I'm going to look at the balance sheets of three central banks. The first of those is the Federal Reserve, and here you can see that the increase in the Fed's balance sheet as a result of its asset purchases has been almost entirely in what they call treasury securities, that's US government bonds, and in mortgage-backed securities, which are often issued by banks and others, usually insured by Freddie Mac or Fannie Mae, which nearly went bankrupt in the financial crisis. They issue their own securities as well, which are referred to there as agency securities. And during the financial crisis, the Federal Reserve bought quite a lot of those, but they haven't been doing that more recently. And that accounts for almost all of the quantitative easing that the Federal Reserve has done. At different times, of course, they've bought a range of other assets during the financial crisis to help out particular parts of the financial system that were in big trouble. They certainly bought a lot of assets from other companies, financial companies, insurance companies that were in danger of going under. And they also extended liquidity swaps to foreign central banks to alleviate temporary shortages of US dollars. They did that in March last year in a significant way as well. But overwhelmingly, what the Federal Reserve has bought has been government bonds and mortgage-backed securities. Now, as I mentioned before, in order to purchase those bonds, they create money by crediting the accounts of the banks with whom the sellers of those bonds or mortgage-backed securities bank in the accounts that they hold at the Federal Reserve. What I want to particularly draw to your attention is that the overwhelming bulk of the increase in the liabilities side of the Federal Reserve's balance sheet, that is the counterpart of the increase in their assets, has been the reserve balances which banks hold at the Fed. If you look at the currency line, and currency is, or at least notes are a liability of the central bank in every economy, that has continued to grow at the same steady rate that it had been before all this quantitative easing started. That's what I mean when I say that quantitative easing is not about scheduling overtime at the note printing works in the way that Robert Mugabe's Zimbabwe or Hugo Chavez and Nicolas Maduro's Venezuela has been doing. Overwhelmingly, the money which the central bank has created in order to finance the purchases of bonds and mortgage-backed securities has ended up back on the other side of the central bank's balance sheet in the form of increased reserve balances or deposits that the banks hold at the Federal Reserve. Let's look at the European Central Bank now. And again, you can see that a significant part of the increase in their balance sheet has been the purchase of government securities issued by all the member governments of the Eurozone. And the ECB has to adhere to some pretty strict protocols around the proportions of different government securities which they buy to avoid any suggestion of favoritism to some governments over others. But in contrast to the Fed, the European Central Bank has also done a fair bit of lending directly to commercial banks, with the hope of them in turn lending more to households and businesses. But again, if you look at the liability side of the European Central Bank's balance sheet, you can see that the supply of currency has continued to grow at a slow, steady rate. And the counterpart to the increase in the ECB's assets has been a substantial increase in bank deposits with the European Central Bank, which banks are continuing to hold despite the fact that the ECB levies a negative interest rate on those deposits that they hold with the central bank. Again, there's no extra work being done at the note printing works for the ECB. And now let's look at the Reserve Bank of Australia, which of course was a much more recent convert to the notion of quantitative easing. The Reserve Bank of Australia has put in place a quite significant term funding facility, as they call it, which has lent almost $190 billion at 0.1% to authorised deposit-taking institutions, mostly banks, for them to in turn lend out to their business customers. And the way that program has been structured has given particular incentives for lending to small to medium enterprises. But the Reserve Bank has also bought very significant quantities of federal and state and territory government bonds through their bond purchase program. Again, if you look at the liability side of the Reserve Bank's balance sheet, you can see that the supply of cash has been rising at the same slow, steady rate during the QE period as it had been before, and that almost all of the increase in the assets of the Reserve Bank has been matched by an increase in the balances which the banks hold in their exchange settlement account balances at the Reserve Bank. They're the accounts through which traditionally the banks settle their transactions with each other that their customers undertake, but increasingly now they're holding a large proportion of money on deposit at the Reserve Bank, earning less than the official cash rate. So what are central banks trying to achieve by doing all of this? Well, the principal purpose of quantitative easing is to ease monetary policy by other means, when the scope for easing monetary policy in the conventional way by cutting interest rates has been exhausted, because interest rates have gone as low as they can practically go. And as I said before, for most central banks, that means zero. Purchasing government bonds can help lower interest rates that central banks don't directly control. Interest rates in floating rate loans, as is the case with mortgage rates in Australia, for example, normally do move in line with the central bank's official cash rate. But interest rates on fixed rate loans are typically priced off longer term bond yields, which central banks don't directly control. And in countries like the United States, where almost all mortgages are at fixed rates, and a lot of business borrowing is either done at fixed rates or it's done through the corporate bond market, then the central bank cutting its official cash rate doesn't directly affect those interest rates. It may do indirectly over time, of course. But by the central bank purchasing large quantities of government bonds and so pushing up their price or commensurately pushing down their yields, that leads to lower fixed term rates. In the United States, that means lower mortgage rates than others, and lower rates for business loans and lower rates for corporate bond yields. And that's a form of monetary policy stimulus. By buying longer term bond yields, central banks can reinforce what they like to call their forward guidance as to how long interest rates will stay at very low levels. So in the Australian case, for example, the Reserve Bank started saying in November last year that they would keep the cash rate at its record low level for 3 years. And to reinforce the sincerity with which they were saying that, they started buying 3-year government bonds to ensure that their yield came down to 0.1% as well, where they'd set the official cash rate. And that's been an objective quite explicitly of the Federal Reserve and the European Central Bank and other central banks, to underscore what they say in words about how long they intend to keep interest rates at record low levels. One of the other things that central banks buying government bonds can do is encourage people who currently hold government bonds to be more willing to purchase riskier assets. I mean, almost by definition, when central banks buy bonds off pension funds and banks and other holders of them, those sellers then have to do something else with their money. And if they put it into other types of bonds, corporate bonds, if they buy shares or if they buy other assets such as property, almost by definition, it pushes up their price, increases wealth for those who hold them, and therefore, via what economists have long understood as wealth effects, hopefully encourages more economic activity that creates more jobs. Another way of thinking about the same thing is that since the price of most long-term assets like shares, but also commercial and residential property, are either explicitly or implicitly priced by reference to their yield, which in turn moves not exactly in line, but tends to move in the same direction and by similar amounts as bond yields. Pushing bond yields down also contributes indirectly to boosting asset prices with the consequences that I mentioned before. Purchasing other types of financial assets, such as mortgage-backed securities, also helps to keep their yields down. And during the financial crisis in the United States, that was particularly important because had the Fed not bought mortgage-backed securities in large quantities at a time when nobody seemed to want to hold them, mortgage rates in the United States could have gone through the roof at a time when the housing market was already on its knees. And then finally, direct lending to banks by the central bank can and has boosted the supply of credit to the private sector and brought down the rates at which that credit is made available to households and businesses. Now, as I said, this is about creating money. And it's interesting to note that the quantitative easing which central banks have undertaken over the past year or so has had a much more obvious impact on money supply growth, as measured by M2 or M3, as the case may be in different countries, than it did during the financial crisis of 2008-9, when central banks were last doing that on a big scale. Here's an explanation from a monetarist perspective of the differences between those two periods, and also why, in the view of most central banks, what they're doing by creating money in this way to purchase financial assets isn't going to result in markedly higher inflation, as many people argued it would when they first started doing it. Now, what I've shown in this first chart here is for the United States M2. That's the most commonly used measure of the money supply. It's notes and coin plus bank deposits owned by the non-bank public. And I've shown that against the monetary base, which is the liabilities of the Federal Reserve. And you can see that the monetary base grew at an extraordinarily rapid rate during the financial crisis of 2008-9. It grew by more than 100%. But the money supply itself didn't accelerate at all. In the more recent episode, the monetary base has grown at its peak by a little under 60%. But by contrast with what happened 12 years ago, the broader measure of the money supply, M2, grew at its fastest rate since, as it happens, the 1860s, in excess of 25%, far more than it did during the periods that Milton Friedman was writing about when he said that excessive money supply growth was the main cause of inflation. Now, what's the difference between the two episodes? Well, the difference can be seen by looking at what's called the money multiplier, which is the ratio of the M2 to the monetary base. What that in effect tells you is the speed at which the banking system turns the base money supplied by the central bank into the credit that's made available to the housing sector. And what in effect happened during the financial crisis of 2008-9 is that the money multiplier collapsed because the banking system was stuffed as a result of the financial crisis. That's actually what happened in the Great Depression in the 1930s, of course. But because the Fed at that time did nothing to offset the factors that were bringing on the Great Depression, they let tens of thousands of banks go to the wall rather than do the sort of things that the Federal Reserve did in 2008-9. That was really what put into the Great Depression. And that was, of course, one of the earlier pieces of work that Milton Friedman did that made him famous. And again, famously, on his 90th birthday, Milton Friedman's 90th birthday, Ben Bernanke promised him that should something like that happen again, the Federal Reserve wouldn't make that mistake again. And I suppose it's illustrative of what my late mother used to say about the Lord moving in mysterious ways, but he somehow ordained that when what happened in the 1930s did happen again in 2008-9, the guy in charge of the US Federal Reserve was Ben Bernanke, who'd spent his academic career studying the mistakes that the Fed had made in the 1930s, and there was probably nobody in the world better placed not to repeat those mistakes than Ben Bernanke. So the quantitative easing which the Federal Reserve undertook at the time of the global financial crisis was more or less explicitly designed to offset the collapse in the money multiplier and prevent the money supply from shrinking as it did during the Great Depression. But as you can see, that's not what's happened during the more recent episode, where the money multiplier has actually been, although it's never recovered to what it was before the financial crisis, has nonetheless been heading in an upward direction. Rather, what's happened this time is that the so-called velocity of money has dropped precipitously. Now, the velocity of money had been heading down since the early 1990s. The velocity of money is the speed with which the stock of money turns over in order to finance all of the transactions that make up gross domestic product, or GDP. That had been declining steadily through the 1990s, but it fell like a rock with the onset of the pandemic. And essentially what that's saying is that all the money that the Fed was creating through its second bout of quantitative easing was not going into financing an increased volume of transactions in the economy, but rather, as I showed you earlier, was just ending up on the other side of the Fed's balance sheet in the form of extra deposits that the banks were holding on deposit with the Federal Reserve. And ultimately, that is why the quantitative easing, the money creation that central banks are engaging in now, is not creating inflation. What you can see is that around the world, most countries are experiencing a significant increase in upstream inflation as captured by so-called producer price indexes. And that's happened a number of times before in the last 12 years. On the current occasion, it's being caused by a combination of a strong turnaround in commodity prices, oil, food, steel, and metals from this time last year, by the shortage of semiconductors that's the result of a complex array of factors, including a fire at one of Japan's biggest semiconductor factories and the worst drought in 50 years in Taiwan, which is the world's biggest producer of semiconductors, that's in turn causing problems for the motor vehicle industry, for example, bearing in mind that cars are often described these days as computers on wheels. And it's also a byproduct of some other blockages in supply chains that's reflected in a 500% increase in container shipping rates. None of those things have got anything to do with central banks creating money through quantitative easing. And what I draw to your particular attention is that while this increase in producer price inflation, upstream price inflation, is almost uniform across the whole world, including in emerging countries like China, only in the United States has that increase in PPI inflation fed through into an acceleration in consumer price inflation. It hasn't happened in Europe, it hasn't happened in Japan, it hasn't happened in Canada, it hasn't happened in China, and it hasn't happened in any of the other emerging Asian economies that I haven't shown in this chart. The main reasons for the acceleration in inflation in the United States arise from things that are happening in a very small number of industries, admittedly in a big way. 65% of the increase in the core CPI in the United States over the last 3 months, and a bit over 60% of the increase in the CPI over the last 12 months has come from 6 items that represent just 13% of the core CPI basket. 4 of those items are to do with the purchase or operation or rental of cars and trucks. And indeed, the US is something of an outlier in terms of including used car prices in its CPI. Most other countries don't do that. The other two components that have contributed in an outsized way to the acceleration in US inflation over the last 3 or 4 months have been airfares and hotel and motel charges, which have returned to their pre-pandemic levels as the US economy has opened up after falling precipitately during the early part of the global financial crisis. The other contributor to the acceleration in the CPI over the last couple of months has been the increase in what the US statistics call homeowners equivalent rent. That's the rent which the statistician in the US notionally assumes that homeowners pay to themselves as a way of getting the CPI to reflect something about what's happening to housing costs. Now, almost no other country in the world measures housing costs in that way, and most other countries' CPIs don't give as big a weight to housing costs as the US CPI does. And it's for all of these reasons that the central bank in the United States, the Federal Reserve, is saying that almost all of this increase in inflation is transitory. It's not going to last forever. It's hard to see inflation sustainably picking up in the United States when the unemployment rate's still close to 6%. And as Jay Powell, the chair of the Federal Reserve, said overnight, that's understating the true situation because the labour force participation rate is still a long way below where it was prior to the onset of the pandemic. Certainly, quantitative easing is contributing to the inflation of other things, particularly house prices, in New Zealand in particular, but even in countries that didn't have house price inflation in the years leading up to the global financial crisis, like Germany, are seeing plenty of it now. And some of that is the result of the decline in bond yields that implicitly go into as a factor in house prices. Some of it's due to the more readily available credit or to the impact that quantitative easing has had in pushing down mortgage rates in countries where most mortgages are at fixed rates. For all that we're focusing again on house prices rising in Australia, they're actually rising a lot less in Australia than they are in many other developed countries. Nor has quantitative easing resulted in the collapse of currencies, as had been widely predicted by many when the Federal Reserve in particular began printing money, in inverted commas, to buy financial assets in 2008-9. It could be that one of the reasons for the fact that no currencies have collapsed has been because all of the major economies have been doing it, rather than just one doing it in isolation. And certainly from the Australian perspective, one of the reasons why the Reserve Bank started buying longer-term government bonds in November next year was out of a fear that if they didn't, the Australian dollar might go up even more than it had already been doing, which would be unhelpful for a central bank that had undershot its inflation target for the best part of 5 years in a row. It's a legitimate question. Has QE been effective in meeting central banks' objectives? And my answer to that would be that it does seem to have enabled them to achieve easier monetary conditions than would have been possible had they relied solely on conventional monetary policy tools such as official cash rates. And you can see there I quote a bit of evidence from both central bankers themselves and academic researchers that attempts to measure how much of a contribution to faster growth or higher inflation purchasing bonds has done. The consensus appears to be that purchasing assets equivalent to about 1.5% of GDP has the same effect in stimulating economic growth as a 1/4 percentage point cut in official interest rates. The Reserve Bank here says that their bond purchase program has lowered long-term interest rates by about 0.3 of a percentage point. And as I mentioned before, one of the other factors that motivated them to purchase longer-term bonds was a belief that if they didn't, the Australian dollar could well have gone through 80 cents. And certainly the Deputy Governor and the Governor of the Reserve Bank have asserted with some confidence that the Australian dollar is lower than it otherwise would have been as a result of the QE that they've been undertaking. What's less clear is how successful quantitative easing might have been in achieving central banks' ultimate aims of returning inflation to their target band, which the Japanese have had no success in doing, even though they've been pursuing QE now for more than 20 years, and which neither the Federal Reserve nor the European Central Bank have been able to do, despite pursuing quantitative easing for the past 10 years. So it's an open question as to whether or not central banks have actually been able to achieve all that they want to through the process of quantitative easing. But what might be some of the other consequences or side effects of quantitative easing? And this is where I want to wind up this presentation. Many people have argued, and central bankers themselves have occasionally conceded, that quantitative easing could have contributed to a further widening in inequalities in the distribution of wealth. The argument for that, of course, is, as I argued before, quantitative easing does work in part by pushing up the prices of shares, other financial assets, and property, which of course are disproportionately held by rich folks rather than people of more modest means. Guy Debelle, the Deputy Governor of the Reserve Bank, among others, has pushed back against that argument by saying that quantitative easing has prevented bigger rises in the unemployment rate that would have had a bigger impact on inequality than people's house prices getting higher. I guess that ultimately comes down to an empirical argument, but you can see perhaps that there's no consensus on that. Separately from its impact on the distribution of wealth, quantitative easing may have increased the risk of financial instability at some point in the future via the effect that it's had on asset prices. If it is true, as it probably is, that quantitative easing has pushed asset prices up further than would have been the case otherwise, then if and when quantitative easing comes to an end, that could result in a significant reduction in asset prices. And we know from the experience of 12 years ago that that can have some pretty serious consequences for a whole lot of people and for the economy as a whole. Perhaps some evidence for that occurred in 2013 during what came to be known as the taper tantrum, when Ben Bernanke at the Federal Reserve, then Janet Yellen, talked about tapering, that is winding back the pace of their bond purchases, and there was a pretty savage reaction in emerging market currencies and stock markets that brought on a significant slowing in economic activity in many of those. Interestingly, when the Fed actually did taper its bond purchases rather than simply talk about them in 2018, 2019, there weren't nearly as such serious consequences for emerging markets or for the US economy or any others as might have been feared on the basis of what happened in 2013. But nonetheless, there still remains an enormous amount of uncertainty about the other side of quantitative easing. Apart from that instance in 2018-19, when the Fed did stop its bond purchases, we haven't actually seen any real life examples of a central bank exiting from quantitative easing. To put it differently, nobody really knows how to do quantitative tightening or what it looks like. Although almost all central banks that are doing quantitative easing have indicated that they're going to taper or terminate their asset purchases well before they start raising official interest rates. And given that a lot of economies are now making progress towards their goals of fuller employment and inflation getting back to their target band, as Jay Powell again acknowledged in his testimony overnight, and some other central banks like the Bank of Canada, the Reserve Bank of New Zealand, and the Norwegian Central Bank have also foreshadowed, maybe we're going to get to find out over the next 18 months what quantitative tightening actually does look like. But in the meantime, can I thank you for listening to all of that? I'd now welcome any questions that you may have that you've submitted through the chat, or that Rati has managed to pick up, and perhaps she can read them out. Or I think if people can unmute their microphones, they can ask questions directly, can't they, Rati?
Yes, I can unmute them if they would like to talk. If you want to talk, you can put a note through chat to me and I can unmute you and you can ask questions. But in the meantime, Saul, there are a few questions here, both in the Q&A box and some from LinkedIn audience and so on. You said that QE is not the same as MMT. I am still not very clear. Can you explain that again?
Yeah. Well, yes, I mean, I'll talk about this at much greater length in a month's time, but in simple terms, as I understand it, and I don't claim to be an MMT adherent or devotee, but as I understand it, modern monetary theory looks at governments and central banks as being part of the same ultimate parent entity, the public sector, and it sees little difference between borrowing directly from the central bank through the primary market and having the central bank buy bonds through the secondary market from people who have bought bonds in turn ultimately from the government. And another way that MMT thinks about this is that since all the interest which the government pays to the central bank on its bond holdings gets paid back to the government by way of a dividend on the central bank's profits, then why the bother paying any interest at all? Why not just have the central bank in effect deposit free money in the account which the government runs at the central bank? And MMT argues that if you do that in circumstances where there is high unemployment or excess capacity in an economy, then that won't be inflationary. Now, as it happens, I think that insight is actually broadly correct, that monetary financing of government deficits when there is ample spare capacity in an economy need not be inflationary. And that comparisons with Weimar Germany or Venezuela or Zimbabwe that some people make when they're responding to proponents of modern monetary theory don't fully understand the difference between those circumstances and what MMT proponents are talking about. But where I draw some important distinctions are here. First of all, modern monetary theory proponents say that it should be up to the government of the day to decide whether or not the central bank undertakes direct financing of budget deficits and the terms on which it does it and when they stop doing it. Whereas in the case of quantitative easing, it's the central bank that decides whether or not to do it, how much of it to do, and when to stop doing it. And in my perspective, elected governments and central banks have very different motives when it comes to making decisions about what deficits to run and how to finance them. Elected officials want to get themselves re-elected. And the idea that there might be free money that they can spend without having to annoy anybody else by raising taxes or without having to create debt that someone at some point in the future might have to pay back is something that I think politicians would not be able to wean themselves off from. And when I talk about this in 4 weeks' time, I'll give a couple of historical examples which demonstrate that. Central banks, on the other hand, are independent of governments. They, at least in advanced economies, make their own decisions free of political pressure as to whether to tighten or ease monetary policy, how to do it, and for so long. And I would have far more faith in central bankers making the decision about whether, how, and for how long to finance government deficits than having elected officials with all the perverse incentives that they have making that decision instead of central banks. So that's my answer to that question, Rati. There's another one here who's asking via LinkedIn, a layperson's question, does the quantitative easing not devalue fiat currencies and consequently increase the value of relatively scarce assets? Now, I apologize if I haven't properly understood that question. If by the value of fiat currencies, that is ones that are issued by a central bank without being fully backed by gold or some other asset that's in limited supply, what people normally think about in terms of the value of that currency is its purchasing power over goods and services. And that's what most people understand by the concept of inflation that's measured by consumer prices. And what I've tried to show here is that there's no reason why what central banks are doing with regard to quantitative easing should create a runaway acceleration in the prices of goods and services that are measured in the CPI. And there is no evidence so far in the 20 years that the Japanese have been doing it, and in the 12 years that other central banks in Europe and the United States have been doing it, that it has caused runaway inflation. Indeed, the frustration, if there is any in the part of central banks with quantitative easing, is that despite doing pretty large amounts of it, none of them has succeeded in getting their inflation rate sustainably back into their target ranges, and nor has that been the case in Australia either. Yes, from a different perspective, if your concept of the value of money is how much of that money will buy you assets like shares or property, then I guess you could argue that quantitative easing has contributed to the devaluation of money measured in terms of those assets. Whether it's done so any more than the conventional monetary policy means of reducing interest rates to record lows, whether it's done any more than, for example, the provision of very generous tax breaks to property investors in particular through, in the Australian context, things like negative gearing and the capital gains tax discount, that now seem as though they're going to be a permanent feature of Australian life rather than something that might be at risk of change depending on the outcome of the next election. They contribute to devaluing the currency in that particular sense as well. So to say that quantitative easing has made a unique contribution, or that it wouldn't have happened without quantitative easing, I think is not borne out by the evidence. I think there's a couple more questions there, Rati, if I can just get that to scroll down for myself. Someone's asking here, Jocelyn, is the other side a growing balloon that will blow out consumer debt? Well, the interesting thing is that if we're talking specifically about debt taken out to buy things other than housing, no. That's been declining as a proportion of incomes, and indeed in absolute terms for most of the last 15 or so years. Consumers in most countries are not putting significant amounts of additional debt on their credit cards or taking out, car loans and things like that in order to finance purchases. Yes, they certainly have been taking out increased amounts of mortgage debt. Interestingly, that hasn't hurt their balance sheets, because the houses they bought with the increased mortgage debt have gone up in value by more than the amount of debt that they've taken on, while the interest rates that they have to pay on that mortgage debt have fallen so much that even though consumers in aggregate have more debt, they're spending a smaller proportion of their income servicing their debt than when they had less of it before all of this began. Now, that could change at some point when, for example, central banks start actually putting up interest rates, if that's what and when they decide to do it. Not that I think they'd be putting interest rates up significantly, but of course, if they do put interest rates up a bit and house prices start to come down, then that could have adverse consequences for the economy. I mean, nobody really knows, and that's one of the risks that I was referring to when I talked about some of the things that we still don't know about quantitative easing. Now, Tim here is asking, is it possible to balance the impacts of quantitative easing on interest rates and currencies by conventional monetary policy? Yeah, I guess you could. I mean, if, for example, you thought there were too many risks associated with unwinding quantitative easing and so instead kept purchasing bonds but started raising interest rates, I mean, I guess in theory you could do that, but most central banks appear to think that raising interest rates is a more powerful tool than purchasing government bonds, and it would appear that they want to stop doing the latter before they start doing the former. And so while that is theoretically possible, I don't think we're going to see it tested out in practice. Tim's also asking, wouldn't that negate the impact of doing QE in the first place? The answer to that's right. Absolutely, yes. Percy Allen, hello Percy, thanks for being here, is asking, if QE has stimulated real growth but only asset price inflation, why should central banks not adopt quantitative investing and invest directly in productive capacity? That's an interesting question. The answer that central banks would give to that is that it's not within their remit, and most of them would say, nor are they competent to or qualified to make judgments about what are the most appropriate investments to be putting what is ultimately the community's assets into. And I think that's the right judgment for them to make. You could argue about this. Some people might want to contest this, and I wouldn't say this is necessarily sort of the irrefutable truth. But in my sense, there's something inherently more political about decisions regarding taxation or decisions regarding government spending than there is about decisions about interest rates, which is why I've always been cautious about the idea that government should somehow outsource counter-cyclical fiscal policy to some kind of independent body in the same way that making monetary policy has been outsourced to independent central banks. That's a proposal that comes up from time to time. But whereas I think the movements up and down in interest rates don't have a significant political dimension, decisions to raise taxes do have a political dimension, because you have to make a decision about who gets to pay the extra taxes or to benefit from a tax cut. And the same is true with almost all categories of government spending, unless it were to be just simply dropping a fixed amount in everyone's bank accounts, although even then dropping a fixed amount in people's bank accounts is a political decision as well. But certainly deciding which highways to build or which schools to build would have an inherently political component in it, which I think should be taken by elected officials who are answerable to the people for their decisions rather than by an independent central bank. The one thing that some central banks are doing, which perhaps does have a political dimension, but they're nonetheless doing it, the ECB, the Bank of Japan, and the Reserve Bank of New Zealand have been particularly forthright about this. They're saying that they're going to take climate change criteria into account in some of their quantitative easing decisions. So the ECB is already saying that they're thinking about the climate change credentials of the banks and companies whose securities they might contemplate buying. They're saying that they want to see appropriate disclosures of climate risks from banks if they're going to buy their securities, or if they're going to be made available to central bank lending programs and funding programs. Likewise, some central banks, and the Reserve Bank of New Zealand has been pretty forthright about this, saying that they are going to take into account the green credentials, the climate change credentials of the companies whose securities that they might buy or to whom they might lend. The Bank of Japan has said just about 2 or 3 weeks ago that they're going to set up a very large fund to lend essentially free money for up to 10 years to banks to in turn finance programs that will help reduce Japan's CO2 emissions. So in that dimension, Percy, I suppose central banks are doing a little bit of what you're suggesting that they do. But I think in the political system like we have, we need to be fairly careful about the extent to which we allow people who aren't accountable to us at election times to make some potentially momentous decisions like that. Tim's also asking, and we might need to make this the last question, can you increase money supply by QE and control inflation and currency depreciation by tightening monetary policy at the same time? That might be possible. But I suspect that the second part of your question, that they'd cancel each other out, is probably the right answer. What I'm not sure about is whether in cancelling each other out, they might still not have different distributional consequences, that is, different consequences for different parts of the economy, even though in aggregate they cancel each other out, and whether or not those different consequences might be something that you actually wanted to achieve, in the same way that, for example, a decision to raise 100 million in taxes and spend it somewhere else is going to have different consequences for different groups within the community, even though the aggregate impact on the budget will be zero. That might be something that central banks would contemplate, but it's not immediately obvious to me what the effects of that might be. I think since it's well after 6, we might do that. Byron, I see you've asked another question. I'll come back to you by email privately, I think, because we have gone over 6, so it's probably time to wind up. Rati, can I hand back to you?
Thank you, Saul, for the lovely presentation, and it's a lot to cover. Saul's next presentation is a continuation of this. It is about modern monetary theory. It's another big topic. So if you like to join us on that webinar on the 24th of August, I have a special discount code for you. It is July 21, all capital, and it is going to be just available for this weekend for the attendee of this webinar today. So thank you for joining us, and we look forward to see you again in our next webinar.
Yes, thank you, Rati, for hosting so well. Thank you, everyone, for being here. Hope you got something out of it. If you've got any feedback that you'd like to give, I think we're going to send out a survey questionnaire afterwards, but otherwise you can reach out to either Rati or me at sauleslake.com, and you can see a recording of this webinar, and the slides I used will also be up on the website later on. You can also go to the website and subscribe to our weekly chart pack, and that will also get you access to the other stuff on the website that's behind the paywall. I hope some of you will consider doing that, and I look forward to seeing all of you and maybe some of your other friends at the website we're running on MMT on the 24th of July. But for now, thanks, and enjoy the rest of your evening or day, as the case may be.
Yes, and please complete the questionnaire on your way out. Thank you.